or our forecast. You know, the economy's problems are a little bit bigger than real estate. Unemployment is going to remain at 9%. There are some aggressive estimates that it'll be down to 7% in the next 3 years. And you combine that with massive consumer and government debt, it is clearly very challenging. And we have a continued weak recovery through 2011. We've got some positive news as it relates to vacancy rates. We do think they're going to start to trend down. And again, we don't need to get ahead of ourselves. There actually could be a supply problem in some submarkets. You just need to make sure you know your market. Absorption is going to remain flat. I do think we're going to get positive absorption next year. Don't see any kind of speculative construction anytime soon. Investment sales for 2010, we had a big year. We think that'll increase, again, probably not 75%, but another 40, maybe 50% in 2011. And land prices, whether we like it or not, are going to be more reflective of true values. I want to close with our forecast with these product categories, tell you what we said about 2010 and tell you how we did, and then tell you what to expect for 2011. In the office and industrial leasing and development market for 2010, we said it would be another slow construction year and we'd see some stability late 2010. We were right here, only 250,000 square feet built in both markets. Vacancy did move upward, but again, some signs in late 2010 that we're seeing some stability. For 2011, minimal new construction. Vacancy rates, as I've mentioned, will begin a trend downward. Absorption will be minimal, and rental rates will hit bottom. In the retail market, we said coming into 2010 there'd be underperforming stores. They'd continue to vacate. Retailers are just opening few stores, not a lot of consumer confidence, and they want to be in the perfect location, and they got to have a good deal, and they just were not opening stores like they have been in the past. And actually, we were correct here. Vacancy remains high. The least amount of construction in 2010 in the retail market in the last 20 years, there was just minimal new demand. For 2011, as we go into this year in the retail markets, there'll be a dramatic increase in construction. Again, dramatic is just not coming from a whole lot, but there'll be a lot of construction over in Cary. I mentioned a little bit over in Raleigh. The best locations, the best tenants, they got the best chance of surviving and being successful. The smaller one-off locations are going to continue to struggle. And fortunately, the big box projects that we're seeing, those tenants, we're not seeing as many closures as we have been seeing. In the multi-purpose residential markets, the apartment market, for 2010, our prediction was a lot of new construction across the board, and vacancy would move downward from 10% with good demand. And we were right on here. Again, construction almost doubled from the previous year. Vacancy dropped. It stayed below 10%. I did not think it could get to 6.7%, but it did. And as we go into 2011 in the apartment market, over 8,000 units planned for 2011. Now, I don't think all those will get built. I do think that there's a chance that between 2011 and 2012 that you're going to see this much on into 2013. We're going to get absorption in this market. The market's going to still perform well. I don't know that it can go below 6.7%, but I don't think it's going to go up a whole lot higher. Low cap rates for apartment purchasers are leading to new demands for construction, and this market continues to see success, the apartment market, in 2011. How about the single-family attached residential market? Going into 2010, we knew the first-time buyers would drive some construction, and builders were going to crank up to prepare for 2011. And we're right on here. There's actually been some activity, some actual closings of some dirt for some residential builders to build some stuff because, again, the primary activity has been in lower-priced homes. And for 2011, unfortunately, there'll be a continued low demand. There'll be some activity in well-located and well-priced projects. If you've got the cash and you want your dream home with the theater and the pool, now's the time to go ahead and get that. And average home prices continue to move downward for the fourth year in a row. Your investor outlook for land. You got to have location, 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 or it needs to be cheap, cheap, cheap. Again, whether you like it or not, pricing is more reflective of true property values. We know there's going to be continued foreclosures that are going to be coming on the market. Financing is just tough for this type product. Cash will continue to create opportunities, and if you've got a buyer, you need to try to make a deal. The investor outlook for income property. I mentioned earlier that investment sales, which was another very hot market in 2010, it was up 70% from 2009. I think it'll go up to as much as 50%, increase again as much as 50% as we go into 2011. It's trophy properties. They're looking for large metropolitan areas, apartment complexes, high-end office buildings, and downtowns. REITs had a good year in 2010. They're going to continue to be active in 2011. Now, the private investors that are going to take a little bit more risk on non-institutional grade type product, they're going to push cap rates up because they're taking a little bit more risk. And they want positive cash flows, they want strong leases, and they want good credit tenants. As I mentioned earlier, institutional investors are going to focus globally. And they're going to focus on primary markets. And fortunately, if North Carolina and the region can continue the confidence that we've got now going into 2011, this next 10-year real estate cycle, then they're going to continue to come to our market.